We just went through a month where the market was in complete and utter chaos, and most people are looking for safety. So here's a counterintuitive name, a profitable technology company that pays a dividend, is buying back over 25% of its own stock, has zero sell ratings, and Goldman Sachs specifically called it out as a top small cap pick. Yet the stock has barely moved. That company is Opera Limited, ticker OPRA. The analyst consensus says it should be nearly double where it's currently trading. And the reason most people haven't heard of it is exactly why this opportunity exists. Opera Limited in 2026 is a global technology platform with multiple distinct revenue streams, over 100 million active users, and a business that generated 615 million in the full year of 2025, growing 28% year over year. They're profitable. They pay a semi-annual dividend yielding around 5.4% annually, and they just authorized one of the most aggressive buybacks you'll see from a company this size. Let me walk you through what they actually have. Opera GX is one of the most popular gaming browsers in the world, built specifically for PC gamers with CPU and RAM limiters so your game doesn't stutter while your browser runs in the background. Integrated Twitch and Discord, a design aesthetic built entirely around gaming culture. Among its target demographic, it has genuine loyalty. Opera News is an AI powered content discovery platform with hundreds of millions of active users. Primarily across Africa and parts of Asia, Opera was one of the earliest companies to crack mobile first content consumption in emerging markets, and they've been compounding that audience for years. Next, they have MiniPay. MiniPay is a lightweight mobile payments app built on blockchain infrastructure, targeting users in Africa who don't have traditional banking access. It's early stage, but the total addressable market is enormous. Non-search query revenue, which includes this kind of adjacent monetization, grew over 200% year over year last quarter. And then there's Opera Neon, launched to broad public access in December of 2025. Neon is described as an agentic AI browser, not a browser with a chatbot bolted on, a browser designed from the ground up for the paradigm where AI doesn't just answer questions, but takes actions on your behalf. Now let's look at the numbers where this company truly shines. In quarter four of 2025, they had 177 million in revenue, up 22% from the same period a year ago. Exceeded their own guidance by more than 12 million. Not a small miss, a meaningful beat. Adjusted EBITDA margin of 24%. This is a company generating a nearly quarter margin on over 177 million in quarterly revenue. For the full year of 2025, they had 615 million in revenue, up 28% from 2024. Their 2026 guidance has them hitting 720 to 735 million. Even at that 17 to 20% growth rate, while it does look slower than the 28 they just posted, it's still significant growth at a 23% EBITDA margin on a 1.3 billion market cap company. Now here's the buyback. Opera authorized 300 million in share repurchases. The entire market cap is approximately 1.3 billion. They are authorizing the repurchase of roughly 23 to 25% of their own company. Management is looking at $14 a share, saying this is so cheap that buying back our own stock is the best use of $300 million. That is not a subtle sign. Now, there's three reasons this stock is still cheap. The first is the market cap. Opera is a $1.3 billion company. Large institutional funds either can't own it due to mandated restrictions or won't because the position is too small to move the needle for a multi-billion-dollar fund. The natural buyers for large stocks are structurally absent here. The second reason is Chinese ownership. Opera's majority shareholder is Kulon Tech, a Chinese technology company. In the current geopolitical environment and this week's Iran conflict makes geopolitical sensitivity even higher. Anything with Chinese ownership creates perceived risk for Western institutional investors. Opera is listed in the US, headquartered in Norway, builds its browsers in Poland and Sweden, stores data in Europe, but the Kulon connection keeps a certain class of investor away. The third reason, it simply doesn't get talked about. There's no drama, no executive controversy, no viral moment. It just grows, pays dividends, and buys back stock. Now let's look at why analysts believe in it. TipRank shows Opera with a consensus strong buy. 5 analysts, 5 buy ratings, 0 holds, 0 sells, with an average 12-month price target of 26.30. That implies roughly 95% upside from the current price near 14.71. Goldman Sachs analyst Eric Sheridan maintains a buy rating, arguing Opera is positively leveraged to long-term secular tailwinds in digital advertising and is idiosyncratically benefiting from geographic and product mix shift dynamics. Lake Street recently raised their target to $26 as well. Now, where's the risk in this company? Well, the 2026 growth guide of 17 to 20% is deceleration from 28%. That's real. If it falls further below guidance, the stock likely stays flat or falls. Competition in AI enhanced browsing is intensifying. Google is building Gemini deeper into Chrome. Microsoft is putting Copilot into Edge. Opera Neon is promising but early. If the AI browser category is won by platforms with deeper ecosystems and larger user bases, Opera will lose that battle. A profitable, dividend paying tech company growing nearly 20% annually, trading at a price that gives you a 5% dividend yield, implies 95% upside to analyst consensus, buying back over a quarter of their own stock. Goldman Sachs endorses it. 0 analysts have a sell on it. The reason it's cheap is structural. Small cap, foreign ownership, no hype. That's also why it could stay cheap for a while. The question is Opera the most undervalued, profitable tech company most investors have never looked at? Or does structural neglect become a permanent discount? Let me know down below. And as always, this is just financial analysis, not financial advice. Do your own research.